Welcome everyone to Vested Interest. This is Shane back again for their stock pick of the day video. It is Wednesday, January 24th. We are going to take a look at one out of the communications sector. We have covered this one before on this channel. It is Verizon Communications, and I am long Verizon. I do own this one, so it is one that we're going to review in my portfolio. So let's jump right in the video. And if you are new here or you just want to help out the channel, go ahead and hit that thumbs up down below if you like the video. Hit that subscribe button if you have not done so already, and hit that notification bell. Make sure the bell is rung so that you're notified whenever we put out any new content. Join us here on the journey to financial freedom. Join the Vested Interest community. It really does help a small YouTube channel like me whenever you do all that. Hit that thumbs up, hit that subscribe, and hit that bell notification. Like I said, let's help get the word out that dividend growth investing is the best way, the best path to financial freedom, at least in my opinion, and hopefully yours as well. That's probably why you're here. Now, this is the Vested Interest Stock Screener. This is how I look at a company on a high level. It's also how I set up the video. So we're going to take a look at the business overall, understand the business, growing free cash flow over the last 5 years. We look back about 3 years, but really I like to look back at 5 years or further. I want a growing dividend over time, dividend payout ratio of 75% or less. Now, this does not apply to REITs, BDCs, companies like that are required by law to pay out more. I think REITs are like over 90% of their payout by law. They have to pay out. BDCs typically pay more than that as well. Some other companies out there you can invest in, limited partnerships. Some of those other ones will pay higher dividend yield than the 75%. This is really for just regular companies, regular stocks. Check valuation based on dividend yield theory. We'll take a look at the dividend yield theory and see if the company is showing any undervaluation or overvaluation based on dividend yield theory. Buy below current cost basis or within 15% of its 52-week low. So if I already own it, I'm trying to buy it under my cost basis. If it's one that I'm looking to add to the portfolio, I'll do a discounted cash flow analysis on it, and then I try to pick it up whenever that number is within 15% of its 52-week low. Obviously, the lower I can get a stock, the better, and that should be what you're looking for too. I like things when they're on sale. Return on invested capital and return on equity, I like 10% or better on both of those, or in line with its industry average. And earnings per share growth equal to its industry or 5% plus. And for banks, I add in price to book. Now, you can use price to book for any company, but for banks, it's an easy one. You just use one being fair value, anything under one being undervalued, anything over one being overvalued. For other companies, you want to compare it to its industry average and must meet 5 of 8 to make it on my watch list, or 6 of 9 if it's a financial company. And then I do more of a deep dive into the financials and the strength of the company. Now let's jump back over to Verizon. www.verizon.com is their homepage if you want to know more about this company, and you should. If you are investing in a company, you should understand how they make their money. That's www.verizon.com. That is their homepage where I pulled this information from. Verizon Communications was created on June 30th, 2000 by Bell Atlantic Corp. It's amazing. I can't believe it's been 24 years, but it just seems like Verizon has been around longer than just the last 24 years. And GTE Corp. In one of the largest mergers in U.S. business history, GTE and Bell Atlantic evolved and grew through decades of mergers, acquisitions, and divestitures. Today, Verizon is a global communications technology company delivering the promise of the digital world to millions of customers every day. Right? They're your cell phone provider, maybe your computer or internet provider, your home television provider as well. So they have their hands in communications. That's really their bread and butter. 5G is really the last, 5 years ago, 6 years ago, 5G was all the buzz. Now they're really starting to build out that portion of their company. People are starting using it. Verizon's 5G ultra wideband reaches 200 million customers. Company continuing to expand its 5G ultra wideband network, right? You might be on 5G. And I remember when 3G was the big thing. So it seems like every other year or every 4 or 5 years, we get a new upgrade into the system. So this company is capital intensive, where they are continually reinvesting back into the company, repairing lines, adding new subscribers, adding new coverage areas. And Verizon named NFL's private wireless network, right? Not that that's a huge deal, but since they were, I'm going to take a minute to say congratulations to the Lions. That is my team. I do live here in Michigan, so congratulations to the 2023 NFC North champs. The Lions playing the 49ers this weekend. If you're a football fan, hopefully you're rooting for the Lions this weekend. If not, let me know who you are going to be rooting for. Hopefully not the 49ers, because I'm hoping that they beat them and make it their first Super Bowl this year. But we'll see how that goes on Sunday. Now back to Verizon. The reason we are taking a look at them down 2.23%, we are talking about Verizon Communications, ticker VZ, out of the communications sector, closed out the day at $41.29. Now, this one not too long ago was down in the $34, $33 range. A lot of people were saying, get out of it. It's a dying company. You're not going to make any money. The dividend yield's too high. They're going to cut the dividend. They're having issues with their fiber cables, or their cables leaking into the ground and everything. So it was all doom and gloom. This company was going to go bankrupt, all sorts of stuff going on. I was buying it. So that just, to me, is the time when you see red like that and it's overblown, and it was, in my opinion, looking at the numbers, that's the time you want to be buying. It's rebounded a lot since then. If you were buying back in the $30 range, kudos to you too, because you really locked in a very high dividend yield and a very low cost per share basis. My cost per share basis is a little higher than this. We'll see that in a minute. 52-week range, again, as low as $30.14. Again, I was buying it back here in the 30, 31, 32, 33, 34 range. I was also buying it in the 44, 45 range as well. 52-week range as high as $42.33. Average volume, 22 million. Today's was 23. So not a big sell-off, but a sell-off nonetheless, enough to hit 2.23%. And you can see that sell-off here. Market cap of $173.587 billion. A beta of 0.38. This is much less volatile than the overall market. Price to earning ratio, $15.01. EPS, earnings per share, sitting at $2.75. Next earnings date coming up April 22nd. Forward dividend is $2.66. And a very, very high dividend yield on this one, 6.3% starting dividend yield. Again, if you were buying it back here in the $30 range, this got up to over 8% at times, or touched 8% at times, definitely over 7%. Very high dividend yield on this one, even now that it's rebounded some. Ex-dividend date, January 9th. It is going to pay out February 1st. Looking forward to that dividend. Always do. This one in AT&T I hold as well. Again, I'm not afraid of these type of companies. I look at it, even if it doesn't have a lot of growth, it is a very high yield bond for me with growth. 1-year target estimate, at least according to Yahoo Finance, $42.38. So they see it ticking up ever so slightly there. Now I'm going to look at statistics. Under statistics, we're going to go down to dividends and splits. We're going to take a look at dividend yield theory. To do that, we go to 5-year dividend yield average, 5.15%. We compare it to its current 6.3%, or over here, forward annual dividend yield, same number, 6.3%. And since it is higher and much higher, that speaks to some undervaluation, at least according to the dividend yield theory. For me, I would like a bit more of a pullback. I'd love it to drop back into the low 30s where I can pick up a bunch more. But this is pretty close to my cost basis. Again, we'll see that here in a little bit. So I want a bit more of a pullback if I'm going to add any of this one. Actually, right now I'm adding to a lot of other companies, but this one would not be one that I would be afraid to add to. Now, it does show here the payout ratio is 95.82%. We're going to see there's some discrepancy here between what they're showing on Yahoo Finance and what they're going to show on stockanalysis.com. So I need to do a little bit more research to see which one is accurate. Now, 95, yep, pay ex-dividend date, January 9th, payout February 1st. Now, in the financials, you're going to find a lot of good information there. Their balance sheet, their income statement, their debt-to-equity ratios. What does their assets over liabilities look like? Are their margins growing? Are they paying down debt? Is their revenue growing over time? You know, a lot of good information. You should understand what you're looking at there, and you should be looking at the financials of a company to make sure they're healthy and they can cover their dividend. And the way you look at that is you want to look at their free cash flow. We want growing free cash flow over time, because typically if a company has growing free cash flow, they have growing dividends. Going back to 2020, they were at $19.6 billion. You can see a huge drop in 2021. There must have been some write-offs here. Again, very capital intensive type of business, and they are a bit cyclical. Whenever they do a lot of expenditures, they typically have write-downs like this. So a big drop down to negative $28 billion in free cash flow. Big jump back up in 2022 to 10.4. Looks like so far in 2023, sitting at 13.6 billion. So overall, I would say it is growing, but at least from 2021 to 2023. But overall, from 2020, there is a bit of a drop here in free cash flow. Now, the good thing is they aren't repurchasing shares, but you can see here they are paying back a significant amount of debt every year as well. So that's a good thing to see. I would like them to repurchase shares, but so long as they're paying down debt and their free cash flow is growing, again, at least over the last 3 years, that's what I'm looking for. Now, stockanalysis.com is another source that I like. You pick any sources that you like. Just make sure you're picking more than one so that you can make sure the information you're getting is accurate. And they have 21 analysts that have taken a look at this. They call it a consensus buy, though it's right on the edge there of a hold and buy. So it's not necessarily that many more that are calling it a buy or a strong buy that are calling it a hold or a sell. They have a low estimate of $13, which would be a huge drop. If it dropped down into 13, I would probably back up the semi and just dump a few $1,000s into this one, significantly decrease my cost basis. It has an average estimate of $39.33. That would be, and the $13 would be a 68.51% decrease from where it currently sits. Average estimate of $39.33 would be a 4.79% decrease from where it currently sits. This is probably where I'd want to get into this one, 39.33, under 39 if I could. And a high estimate of $49, which would be an 18.7% increase from where it currently sits. All the while, you could collect that 6+% dividend yield. Now, I like to look at statistics here and look at the financial efficiency of the company. How are they doing reinvesting back into themselves? I like 10% or better on return on equity and return on invested capital. For this one, return on equity sitting at 22.2%, meets the criteria there, but the return on invested capital is a little lower than I'd like. That 10% is what I'm looking for at 8.42%, just under what I want, but not egregiously slow or egregiously so. It's not like this is at a 1 or a negative. So that's not terrible. I'm going to call that a mixed bag on this one. And earnings per share growth, again, I like 5% or better. This one does not meet that metrics at 0.43%. So it is growing, but it is projected to grow ever so slowly, which is part of the problem that people like about this company. And that's what happens when companies get really big like Verizon is. They tend to slow down in growth. Revenue growth also expected to grow just 0.98% over time, at least over the next 5 years. So again, slow revenue growth, slow EPS growth, but starting yield and starting out, it's pretty high. So now let's get over to the dividend. Again, Yahoo Finance had 95%. Stockanalysis.com is showing a payout ratio of 53.52%. I would cut it in the middle. Actually, I do a little bit more research, and I would probably go to a third source, see if I can verify if one of these is correct. But this is saying 53.52%. Either way, it's under 100%, and I actually look more towards this 53.52%, but that may be my bias because I own the company, and I do have 313.339 shares. My cost basis, $41.21, currently at $41.20 or $41.30, so it's a little over my cost basis. That's why I'm up 0.11%. Like I said, I would like it to dip back under my cost basis so that I can continue to bring this down and bring up my yield. So if it dropped back into the 30s, I might nibble a little bit, though it is one of my larger positions at $12,940. As you can see here, going back to 2021, 62 cents. Raised it up October 2021 to 64 cents. Raised it up again October 2022 to 65 cents. Most recently, October 2023 up to 66 cents. So it is 1.93 slow dividend growth, but it is growing. And I would expect again in 2024, sometime in October, for them to raise that dividend up again. Well, that is it for this one. Let me know what you think of Verizon. I know this one and AT&T always are kind of a mixed bag. Some people love them, some people hate them, some people avoid them altogether. That's perfectly acceptable. Everyone has different investing criteria. I'm a little older, so I'm looking for some plays to make a little bit of cash so that I can retire at some point. For some of you younger people, you might be looking for something with a little more growth. That's perfectly all right. Again, we're all in different investing criteria and investing stages of our life. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, hit that subscribe button down below. Join us on this journey to financial freedom. Join the vested interest community. Let me know what you think of Verizon. Again, is it in your portfolio? Is it one you're avoiding? Is it one you're waiting for more of a pullback? And I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. For those of you who have suggested some companies, I will get to them. I'm just trying to get through some other ones in my portfolio as well as some other ones on my list already. So be patient with me. I definitely will get to them over time. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and money. You should never invest any amount of comfortable losing. Always do your own research, best based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.